Sonali. How are you?
Great to have you here.
Yeah, thank you. Thanks for having me.
So we have got to start with what has always been one of my favorite topics, mergers and acquisitions. You are known for it. I would love to just start right there because I know it's on your mind too. What do you think is driving this consolidation? Is there any end in sight, actually?
Several good questions involved in that. So, by the way, thank you again for having me here. Congrats to you and the iCapital team. This is incredible. Only a couple of years in. This is amazing to see how the ecosystem's developed. So congratulations. Yeah, M&A does tend to grab a lot of the headlines. I do like to provide a programming note that at Cetera Financial Group, we are primarily focused on organic growth before inorganic growth, but the inorganic growth grabs the headlines. So we are active in the M&A game. There continues to be consolidation in the broad wealth management industry, whether that's in the RIA form of affiliation or an independent broker-dealer or insurance-based broker-dealer. There's consolidation sort of across the spectrum of models, no doubt about it. To your good question, I think personally what's fueling most of that consolidation is the intense necessity to have scale if you're going to be in this business. This business, generally, I would just call wealth management. You have to have a scale effect somewhere. We're largely building a scale effect. We're converting our size into scale. Those are two different things, but thankfully we're getting a scale effect as we get larger in size. Not every firm has to build for that scale. You can also partner for it. I wouldn't think of building scale behind us doing everything in and around alternatives by ourselves. I rent the scale benefit through iCapital, by example. But I do think it's this necessity to have scale in this industry is what's driving a lot of the M&A.
Right, what stops this train?
It's a good question. Certainly a lot of the M&A, it takes capital. So models that can self-finance, M&A would be the purest way to sort of keep this engine going. Those of us that tap outside providers of capital, we're a private company, we're a portfolio holding of Genstar Capital, the private equity sponsor based in San Francisco. We just did a re-underwrite of Cetera just 2 years ago with Genstar Capital. So we have fresh equity and a full sort of credit stack, through our credit providers. So we think we have access to good, durable, bountiful, cost-effective capital, but it does take capital to keep it going. So if there was a constraint somewhere in the supply of good capital and the financing mechanisms of equity and debt that it takes to keep tapping into the M&A consolidation, that would be a headwind for sure.
Well, it's interesting because a recent partnership struck by Cetera cited the ability to help one firm expand to more than $1 billion in assets over the next 5 years, a 5-fold increase than what was currently experienced. How do you see this type of AUM expansion happening? You mentioned organic versus inorganic for you and your partners now, right? So
For sure.
What is driving that growth?
For sure. So our focus is actually on organic growth, and we're trying to do it at Cetera on a very skin in the game, involved, purposeful basis alongside the advisors that are on our platform. We have over 11,000 financial advisors at Cetera that use our platform. We don't sit on stages in front of 11,000 and say, we really would love to get your growth. We don't grow unless you grow. Happens to be true, but we put our money where our mouth is. So the way in which we align resources around the advisors that we serve, the way in which we sort of financially incent them, we want to be a growth partner with them so that we have a shared accountability to help drive their growth and to give it a little more texture. For our biggest, fastest growing practices, the relationship starts on the basis of us, the home office of Cetera, co-creating with the advisors we serve a multi-year business plan. And then within that plan, we each take responsibility for that multi-year plan. So the nature of the relationship is not, I walk into an office and say, hey, you're supposed to be growing 5x over the next, how are you doing? Instead, it's, hey, Cetera's falling behind on these 3 work streams, you're falling behind on these 2. So there's this shared accountability and driving the growth together, and that seems to be, resonating and producing good organic growth results.
Well, it's interesting because we started with M&A as one lens, but realistically speaking, there's M&A, there's partnerships, there's all sorts of ways to be engaging with the broader community here. How do you make decisions between what you bring into your platform via acquisitions versus other types of relationships?
Yeah, it's a good question. And so in that category, I'd say there's acquisition, there's recruiting, there's partnership, and then there's good old-fashioned household acquisition, the purest form of organic growth. The way we think about M&A, there are 2 types that we pursue. One would be, in fact, we call scale transactions. So where can we By example, where can we maybe buy the embedded wealth and brokerage network of an insurance company that does not find that having a subscale, sort of proprietary sales force doesn't really work. We acquire that team, that network perhaps, some of them have been quite large, and we get an immediate scale effect on plugging them into the broader sort of Cetera ecosystem. So that would be a scale transaction, and that's really where most of these consolidation trades are happening in this still consolidating market. But we also pursue adjacency deals, which are really capability-based deals. So we bought a trust company, by example. We bought an insurance, BGA, Brokers General Agent. So it'll be where we're looking on our own chessboard and saying, we're building a level of acumen. We see a screaming market need. It's time for us to acquire our way into a certain capability we don't have today, because that's the fastest path to impact than building or partnering. But as you referenced, partnering is important. Again, as I said, it's a chance for us to rent somebody else's scale, and it's a chance to find partners where we have sort of this aligned interest. Why do relationships like iCapital work really well? We're always on the same side of the table with a partner like iCapital when serving an advisor in common. So finding those, shared aligned incentives in good partnerships are also, a really important vehicle for us.
You mentioned chessboard, and I'm so glad you did, because the same reason I love chess and M&A and backgammon is because of strategy, right? And you were talking about capability additions. What are the capabilities of the future? How do you think about what it takes to really advance in this space that's so fast moving? What are some of the things you find yourself looking at more and more?
At Cetera, we're trying, indulge me being at the Biltmore, I'm going to use a golf analogy, which I probably shouldn't do. So Cetera is in the broadly defined independent wealth space. That means we have a very wide open architecture of solutions that our advisors can draw from. Multiple clearing firms and custodians. We work with iCapital. We work with multiple CRMs, multiple managed account platforms, etc., on and on and on. However, we have a really well-groomed middle of the fairway. That if you use this set of capabilities within the middle of the fairway, good things happen to you, the advisor. You can grow more efficiently. You can get a scale effect. You can drive value through driving better earnings in your own practice. We'll let you out into the rough by choosing the latest new CRM system, and we'll build an integration towards it. I really think long-term, I'm worried that those could emerge as liabilities, because your other embedded good question there is, over time, the firm that has access to the best data in fewer repositories, really clean, fully reconciled, fastest path to getting insights, fastest path to putting your agents on top of that data set, I think great things happen. And the more far out you are into the rough or even out of bounds, it's not impossible, let's say, for the promise of AI to find that data in the rough. Boy, it'd be easier if you stayed in the middle of the fairway. So we're sort of practice managing our advisors, stay in the middle of the fairway while preserving the optionality of playing outside the fairway where it makes sense, but be careful if you play too much, like me, in the rough.
So golf analogy is welcome here.
Sorry.
I think you're good on the golf analogy here. But when it comes down to it, you mentioned a few tech terms. I'm going to bring in the third. No surprise, artificial intelligence. What role is it playing? How do you see it impacting the industry today? How do you see it impacting the industry in 5 years from now?
It's bringing immediate efficiency to us, Cetera. Fastest path to first call resolution and service, because the answer can be served up in real time alongside a human in the call center. That's one example. It's immediate impact to our advisor practices. By example, we happen to deeply partner with Jump AI. Zox is another provider in this space. This idea of it's a companion agent to an advisor in an advisor-customer interaction. It sits alongside the use case and advisor in a quarterly meeting with a client. Note-taking, insights, it launches workflows, follow-ups, all that good stuff. I've been around the industry a long time. At Cetera, we had thousands of advisors adopt, and they pay for it in less than 6 months. I've never seen an adoption curve of any wealth tech, sort of advisor-facing wealth tech move that quickly, particularly when they're paying for it. And so to me, that is immediate efficiency to the advisor practice. They don't need the junior partner sitting in that meeting. They don't need to take the time consolidating notes and launching sort of workflows across their practice. So I happen to believe that advisors will not have themselves replaced by AI, but they will be replaced by the advisor that uses AI better. I'm encouraged by how quickly AI is having a positive impact and the ease with which advisors will adopt when you can show them the direct impact, positive impact it's having on their practice.
Well, efficiency is important, but I also am wondering how much it's adding to ROI right now for advisors.
It's adding to the profitability of the advisor practice. If they're converting that efficiency of their time into, I can book 3 more meetings, I can call 2 more, I can run another seminar. If they're turning that time into more business development, that's going to, be the fastest path to the best return. The other thing I'd say, because you said in the prior question, sort of 5 years out, maybe it'll take more than 5 years, maybe it's 10 years out, but look, I'm just a big believer that maybe it is within 5 years. I think the wealth management industry, the advisors in the wealth management industry, with this adoption of AI, I think it'll be the final stage of the advisor no longer having a knowledge or information advantage over the customers that they serve. But these clients will increasingly come to the advisor asking, is this right? What else should I consider? Am I okay? So, while the information advantage, might suffer a bit, the premium being placed on just coaching and behavior modification and reinforcement, I think is going to continue to go up and up and up. And I'm quite encouraged what that means for the advisor community over time.
We could talk about AI all day, but we do have to also cover private markets. Very curious about what role they're playing in your advisor portfolios and how far along your advisors are.
Yeah, we're early by any measure. We're early. Certainly the asset footprint is the easiest measure for we're early. So we have plenty of higher end, more sophisticated advisors serving high net worth, ultra high net worth investors. They're farther along, very well served by the availability of incredible product via iCapital. No problem there. That is not our power alley. That's Cetera Financial Group, right? We're not Morgan Stanley or Goldman Private Wealth Management. We have a very significant portion of our advisor and client base that's more mass affluent to high net worth. And so in that context, where we're particularly early, we're leaning in heavily to this democratization of alts by leaning on our chief investment officer, Gene Goldman, at Cetera Investment Management. He's put out a series of strategic asset allocation models through which there is an alternative investment completion portfolio. So what we're after is the fastest path for an advisor and their clients to go from a financial planning interaction, which establishes that, let's say, the household could take on some illiquidity. Now, what's the strategic asset allocation that can carve out a portion of that portfolio that could take on some illiquidity risk? And then Gene and team does that allocation and then fills it out. Which asset classes? And actually doing the research down to the manager and vehicle selection. And we go to market that way. Because for our advisors, and iCapital does a great job, yes, they need the education around alternative investments, but to me, the form of education that's coming along now nicely, which I think is going to be the most durable commercially, is the fastest path from financial planning to strategic asset allocation to portfolio construction to manager selection to then keep going, rebalancing, billing, reporting. And that's where we're now putting that in place. And again, even for those completion portfolios, iCapital is in the middle of that relationship and that interaction also. That's where we're early, but I think will produce the more durable and strategic flow for us.
Well, I couldn't agree more, but I've got to say that was the first time I heard your process, which is a very fluent way to get, you have to build the process for everybody to follow. But, with that said, you have a mousetrap built, right? But what are still the biggest hurdles?
It's the first leap is the biggest leap, which is to go from a financial planning based relationship and interaction to that allocation and portfolio construction that includes alts. And so if I could wave a wand and say every Cetera advisor is going to do cash flow based modeling, I have a bias that the cash flow based financial planning, I have a bias that cash flow based financial planning is the easiest way to show I'm your advisor, Sonali, which is, hey, look at this cash flow based modeling we've done in your plan. Your money is going to outlive you with pretty high confidence. That means you don't have to worry about liquidity quite as much. Let's think about 15% being illiquid. Now, what are we going to do about that? Establishing that case for alts in a financial planning context is still the long pole in the tent.
You have a lot of very interesting views of the long-term planning, savings, retirement landscapes. You knew I was going to go with this. Really would love your views about any role of alts in 401k plans.
Yeah, I'd say alts have a terrific role in retirement planning generally, because for the vast majority of U.S. investors, their retirement assets are their longest dated assets. So it should be the place where you can, trade a little bit of illiquidity for the expectation of high return over time, and you can take the cycles in stride because you're in it for the long term. I'm quite bullish on where private market access plays a role in retirement generally. And the 401k, they also will play a role, but I would submit, just pay attention to the surround sound key variables that go into today's 401k. Most of it fueled by Congress. Auto enroll, auto escalate, portability, target date as a qualified default investment option, right? The incredible explosive growth of outsourced plan fiduciaries that are advising that plan. There's a lot of externality that's brought to bear in a 401k plan, and I'm going to exaggerate it. So to just sort of put a bunch of alternatives into a target date or even in a lineup, the reality is the C-suite of that company that's also in the 401k, they probably have private market access somewhere else already, and maybe even in their own individual retirement account and of various flavors. We can't forget that the vast majority of plan participants in 401ks are pretty young, pretty junior. They don't have a ton that's set aside for savings, but for that 401k. So I just personally have not a worry, but just keep an eye out towards, how the illiquidity profile bleeds into a 401k, because most participants can't stomach much level of illiquidity. As a factoid, I think this is true. I forget whether it was Vanguard or Fidelity, these headlines that come across. I think last year was a record for plan participants taking loans or hardship withdrawals out of their 401k plan. So there's definitely a place in retirement generally. There is a place in 401k specifically, but needs to be done in a way that's mindful of the array of wealth and sophistication segment that's all together in a 401k plan.
No, thank you for such a thoughtful answer. So the answer is yes, but.
Yeah.
Got it.
Yes,
okay.
but.
Yes, but. And so, where are some of the biggest successes in alternatives for you?
I mean, look, it's what were the inputs to create an event like this? The democratization has had 1,000, factors go into it. Structures are more individual investor leaning. I'm old enough that when I was in this business in the earliest days, the retail investor tended to be the bid of last resort, or the vehicles that were open were the vehicles that struggled to fill. That's not the case anymore. So to me, the positive factors are, I think private client wealth is a very strategic store of assets that GPs want to tap into, and they've responded in kind. Again, structures, price points, the boots that are being put on the ground around wholesaling and education, the advocacy with regulators and legislators. So those are all really great, I think, durable wins at our back.
It's definitely a lot where that came from. Now, in the course of this conversation, I hope what we're taking away is all the strategic changes that are happening within the wealth business. So with that, my last question to you would be, what is your 10-year prediction? What is the most consequential change that everyone in this room should be considering when it comes to the future of wealth?
10 years. I guess I'll repeat one and I'll give maybe a new one that I think would be exciting. The one I would repeat is sort of 10 years out. I think any practice that is premised on I position myself to solve issues for my clients that they could never possibly understand themselves, I think those are at risk. I think what most advisors do will be knowable, not necessarily actionable with confidence, but knowable in 10 years. So maybe that's a glass half empty. The glass half full, I would say, I think the promise of these technologies, importantly AI, I think the wealth management industry will have a bona fide relationship with more than 50% of the households in this country. I think it'd be a great outcome. Our industry generally supports 10% of American households. There's another 50 that would love access to a human advisor to sort of help them. Yes, still answer a few questions, but eventually just give them a level of confidence that they're doing the right thing and on the right track. Most good advisor practices today would say, my value proposition is so special I couldn't possibly take on more than 100 families. The trick here is over the next 10 years, that same advisor should find a way to do 500 families, because I think they could if they just think more expansively around the tools being brought to bear and how their value prop probably should evolve over the next 10 years to be more the coach as opposed to the mathematician.
What a great view. Mike, thank you for joining us today. Of course, that
Thank
is
you,
Mike
Sonali.
Durbin. He is the CEO of Cetera.
Thank you.
Thank you. We appreciate that.
That's
Thank you.
great. Thank you.